Monday, November 25th, 2019, Maneco 64, home of alternative economics and contrarian views. Even though the FT is a globalist publication, and I don't agree with a lot of their philosophy, I do subscribe to them. There are some good points about subscribing to the FT. I just received an email with a story that's just come out about 15 minutes ago. It's 5:15 p.m. London time, and the story reads, World trade drops sharply in September, dashing hopes of recovery. So where's this data from? Well, it's from the CPB, which is Netherlands Bureau of Economic Policy Analysis. So let's go through this article here. It's very interesting, and especially with what's going on in the financial markets today. We're seeing the stock market rally quite strongly. I think we haven't really quite reached, we might have reached an all-time high here in the S&P. We're up 18 points as I speak at 31.28. The high's been 31.31. The Dow traded above 28,000. It's now a little bit back below it, right? Gold and silver are down, right? So let's go through this article. This is what it says. Reversal of recent upward trend leaves economists fearing continued slowdown in 2020. World trade contracted sharply in September, dashing hopes that the global downturn that had been weighing on exporters had bottomed out. The volume of global trade dropped by 1.3% in September compared to the previous month, after a 0.5% expansion in August, according to data from CPB World Trade Monitor. September's fall reverses gains made in the previous 2 months, which had raised expectations that the worst of the disruption caused by the global trade war has passed. This is a quote from an economist at ING. He says, while news about the negotiations between US and China is mixed at best, trade remains subdued. And it goes on to say, compared to the same month last year, global trade contracted 1.1% in September, marking the fourth consecutive year-on-year contraction and the longest period of falling trade since the financial crisis of 2009, according to the CPB Monitor. So here's the annual change, right? Global trade has contracted, and as you can see there, 4 consecutive months of negative year-on-year growth. So it's the first time since 2009. It doesn't seem to me that it's a good signal for the world economy. Yes, the markets are still going up, but that's mainly because of all the heroin and cocaine that the Federal Reserve has been pumping into the markets. And that's not me who said that. That was, I think, Dick Fisher, former president of the Dallas Fed, who used that term, heroin and crack cocaine, about 3 years ago. I think it was in the beginning of 2016. He used that. He said that QE was basically that for the markets, right? And it doesn't seem to be only the Fed that's concerned. I just received a few days ago a story or an announcement from the Bank of Canada, the Central Bank of Canada, who holds zero gold, right? No gold reserves, the Bank of Canada. This is from their website. Bank of Canada's intention to introduce a standing term liquidity facility. It sounds innocuous at first, but in my opinion, it's quite serious. So let's go through this. Another signal of fragility in the financial sector. All the too big to fail banks, and there are a couple of them from Canada, right? So it says the Bank of Canada is announcing its intention to introduce a new liquidity facility, the Standing Term Liquidity Facility, STLF. They love the acronyms, don't they? The central bankers and the powers that be. It was TARP during the '08 crisis, which I think it was Toxic Asset Recovery Program, TARP, right? It sounds better than toxic. So what's this STLF? Well, let's continue. The STLF will complement the bank's current tools for the provision of liquidity. Well, liquidity is money out of thin air, right? And will strengthen the bank's role as lender of last resort. More moral hazard, right? If banks were safe, they wouldn't need a lender of last resort, right? The bank is committed to regularly reviewing its framework for market operations and liquidity provision to ensure it remains consistent with the ongoing evolution of the Canadian financial system. Under the proposed STLF, the bank could provide loans to individual prudentially regulated members of Payments Canada. Well, that just means Canadian banks, right? That are experiencing idiosyncratic stress where the bank has no concerns about their financial soundness. So if the Bank of Canada doesn't have any concern, why does it see fit to start this new facility? It's crazy, isn't it? The addition of the STLF is another step in the bank's effort to enhance the resilience of the Canadian financial system. Wow, to me it seems that the Canadian financial system, I'm not having a go at Canada, but just like the US financial system, the European financial system, UK financial system, these systems are not resilient at all. If they were resilient, they wouldn't need, banks wouldn't need central banks to lend to them in the last resort, right? So that's what it's all about. There is problems out there in the financial system. The repo market in the US is pointing to that. I think there's 3 Canadian institutions that are primary dealers at the New York Fed, right? And now World Trade, right? Falling off a cliff, it seems to me, not recovering. If you enjoyed this video, make sure you hit the like button. Subscribe to the channel if you haven't yet. Make sure you share this video far and wide with as many people as you can. We need to try to get the message out there that things are not as rosy as they seem. You can also follow me on Twitter, Steemit, and on DTube. I wish you all a great rest of the day. Take care. Bye.